Okay, let's conclude our discussion about bonds and pricing. We want to look at, in particular, some risk elements. We're going to take a couple of minutes talking about default risk, and then in the end, we will explore some of the issues with interest rate risk and how that affects pricing for bonds. So, first of all, bonds are rated. There is a rating system and a set of companies that provide rating. And essentially, what this rating is all about is about default risk. So the highest rating you can get is something referred to as AAA rated. And they refer to investment grade bonds as being BBB rated and above. So what does this rating mean? What does highest rating mean? Highest rating means least risk, least chance of default on debt. As you go down the system, as you go down the ranking system, you are going to find more and more opportunities or more and more chances that companies might ultimately default on their debt. So how does this work? Essentially, one of these companies does a financial analysis of the company. And what they do is they're looking for financial strength, stability. They're looking for opportunities for the downside, opportunities for bad things to happen to this company. So what they're looking for, what higher ratings are looking for, companies typically have less debt, they're more liquid, they have stronger cash flows, and they have no outward appearance of having any challenge of servicing their debt. So again, coming back to our concept that we talked about, investment grade bonds then are going to be at the top. They're the most financially strong of these companies. Junk bonds have less financial strength. Occasionally, we'll see what are referred to as split ratings. Essentially, this is we have these 3 or 4 ratings companies, and they may have a different rating for the same company. Now, you probably won't find a AAA rated company by one and then another company rate that company as a BBB rated. But they may be relatively close, AAA versus AA, etc. But essentially what our challenge is to find out where these companies ultimately fall with respect to default risk. As investors, it's very difficult for us to do this type of analysis. These companies are very important in understanding our ability to analyze companies and find out which bonds we really want to buy. So what the rating system looks like, I prefer to use the S&P data here, or their S&P categorization, but it's just AAA, AA, BBB. Now remember, you said what? BBB and above is investment grade. Below investment grade is what we're going to refer to as being speculative issues. BB, B, CCC, those are what we're really going to refer to as be our junk bonds. Actually, even CCC and below, these are bonds that might actually be already in default or are very close to default. So these are very risky issues in this default range here of CCC and below. So again, what are these? What are the factors? What are the things that we look for, or what are the things that these companies look for when they're thinking about the financial strength of companies? And essentially, we have a set of 5 ratios. They use many more, but this is the primary 5 ratios that they look at. So let's think about these companies, right? So what this reflects here, this shows us the probability of default for companies. So if you look at a company, EBITDA, right, earnings before interest, taxes, and amortization divided by assets, this is just a cash flow number. You can see that this number, a AAA rated company, roughly has about 20.9% is what this company has as this ratio. If you work your way down, you'll see that this cash flow number gets smaller and smaller when you look at the category. Right? Another number that you might be for operating profit margin, profit that the company makes. And again, as this number gets smaller and smaller, we see that the category, the rating goes down. What about debt? This is debt divided by debt and equity. This is just our debt ratio, if you will. But it looks at what? As we go down the rating system, debt gets greater and greater. In fact, 98% is the ratio of a company that's ranked C, right? So again, these ratios, if you look at the average within the category, they are reflective of strength. And as we go down the category range, we find more and more companies having a greater way or a greater potential, if you will, of bankruptcy or of default. So how do we fix this, right? Again, sinking funds, right? We want to make sure that there are sinking funds. Subordination of future debt. We want to maybe constrict how much debt a company can get. If they're certainly in trouble, we don't want them to borrow more. So in our indenture, we may put something in there that will restrain further increases in debt. Maybe we want to restrict dividends, create some kind of a collateral arrangement if the firm is running into issues. So there's lots of things we might do contractual to help the company maintain its financial structure and potentially be able to come back out of whatever the troublesome issues are that are driving it towards a default and possibility of bankruptcy. So the risk structure of interest rates refers to this pattern of default premiums, right? There's a difference between the yields that are based on expected returns and promised cash flows. Promised cash flows comes from the yield to maturity. The expected cash flows are what we expect to get. However, we know that because of default risk, there's a chance that we won't get exactly what we want. So there is what's referred to as a default risk premium. This is the extra that we earn in addition to this promised yield to maturity. It's imposed on the companies as they fall down through these ratings. So if you kind of think about a AAA rated bond, maybe on average they have about a 5% yield. A AA rated bond, it might be 5.2%. That extra 0.2% is the extra yield they get, or the investors will get, because of potential default risk. The 8% for a AAA, if you compare that to a CCC rating, maybe CCC is 12%. So if you invest in a CCC, the premium you get for taking that extra risk is an additional 4%. So again, this is all based on the potential default that's within companies as they continue to gather more and more debt and as the economy changes. Now, one of the ways that this is carried out, if you will, is through something called an Altman ZScore. And if you look at these ratios, and again, we don't really talk a lot about financial analysis in this class, but these are ratios that essentially reflect financial strength. This is what's referred to as basic earning power. This one over here is a turnover ratio. This is a leverage or a debt ratio. This talks about reinvested profits of the owners relative to the assets, short-term assets relative to the total assets of the company. So it gives us an idea of, how much money is in this short-term stuff, when to make money, we actually need things to be in the long-term stuff. And when you calculate this ratio, typically it says, look, if you have a Z-score that's greater than 2.9, you are fairly safe. Less than 1.23 means you are vulnerable to bankruptcy. So let's assume you go in to a bank for a loan. How many requests does a bank get from businesses for loans, on a monthly basis? I mean, they could get hundreds of different applications. Well, what they might do is run the company's financial ratios through this Z-score. Any company that has a Z-score greater than 2.9, they might just automatically give them the funding that they require. Anybody less than 1.23, they would automatically deny them any debt or any loans. So then the only companies they really have to be concerned about are the companies in this mid-range. So that can limit the resources that companies have to spend on gathering information and research, and they can concentrate on those companies that are iffy. So it could save the banks or financial institutions, can save them some time and money, if you will. If you look at the differences in yields, we were talking about this default spread, right? The AAA rated bonds is this black line. BAA rated bonds, right, is a thin blue line right here. You see that. And then we have a new category of just this high yield debt. And these are the yields of high yield. And what you can see is, as we've been talking about, as the risk increases, as we go up this scale, if you will, as the risk increases, we have increases in yields that investors expect to get. So, again, I want to make sure that we understand this risk-return relationship, that it's very important to understand what returns you get. The next topic to start looking at is something called duration. Duration is a measurement of interest rate risk. It looks at two kinds of risk: price risk and reinvestment risk. And essentially what it asks, or what it tells us, is the sensitivity of interest of bond prices to changes in interest rate. So this number might be considered an improvement over yield to maturity, because it also takes into account potential changes in interest rate risk and price risk. So we're going to discuss, as we go through this, several of these topics towards the end of the chapter here. We have several more slides to go through. So, talking about duration, we understand that it might be an improvement over the yield to market ratios because it looks at some other numbers. Again, we talked about comparing sensitivity. Essentially, what bond duration is, it's like a payback period. It talks about the average amount of time it takes to receive the interest and principal. So let's think about a zero coupon bond that has 10 years to maturity. What would the duration be for a zero coupon bond? Well, how long will it take for it to get its return back from interest or coupon payments? Well, the answer is 0. So they will get the entire investment amount back when they get the $1,000 in the future. So the bond duration of a zero coupon bond is equal to its maturity. How this calculation works is it looks at, and it's a fairly complicated formula, but it looks at the weighted average of cash flows based on time, discounted over the time frame of this particular bond's life. So bond duration has the following kinds of properties. Higher coupons will have shorter durations or lower durations, which means they are less sensitive to interest rate changes. Longer maturities have longer durations, which means it will take longer to pay off the debt, but that also means that they are more sensitive to changes in interest rates. Higher yield to maturities have shorter durations, and these variables, coupons, maturities, and yields, they all have an impact on duration. So as these things change throughout the asset's life, duration will change. But coming back to our general understanding or our general concept, the shorter the duration, the less the volatility in bond prices. So again, let's kind of reflect a little bit more. Bond duration is just the average time it takes to receive the interest from the price that you pay. It's a weighted average. There's two formulas. One's called Macaulay duration, and the other is modified duration. The difference between the two isn't as important in just understanding when we use duration in investing, in our strategic planning for investing, we want to use this modified duration formula. Without getting into the details, it just provides us a more pure measure, if you will, of duration scaled on the amount of yield that's incurred in the actual price itself. So essentially it looks at risk with reference to this change in price movement. So for our particular bond that we've been looking at, the modified duration is 8.77. We had mentioned that the pricing, and we saw this in a graph in an earlier video, that showed that the curve of bond prices and interest rates is curvilinear. So the measure of the curve is what's referred to as convexity. Now there are two things. I didn't show you both of them. This is just, relatively speaking, the change in yield or change in value when we only look at duration. Now the problem with this is modified duration assumes a straight line, and we know that convexity is an issue, so the actual answer will be slightly different. So what happens to the bond price if interest rates increase by 0.13%? Well, we know what? If interest rates go up, bond prices are going to fall. So duration says that this change in value is going to fall negative 1.1%. So that means the new price is going to go from $9.35, should fall to $9.24. That should be the new price if interest rates actually do fall. So again, in conclusion, right, we have two more slides to go. So let's kind of pull this concept into vision if we can. Duration helps me understand how bond prices change when interest rates change. And it's very effective, it's very accurate as long as the changes are not too large. So a bond's duration can be used as a viable predictor of price volatility only as long as the yield swings are relatively small. Bond prices change in a non-linear fashion. Duration, as I said, predicts interest rates change, but it predicts it in a linear fashion. When we're actually doing this analysis, we're going to want to look at what happens to duration over the time in a non-linear way rather than linearly. How this works and how we can use this is through a process called immunization. Immunization is essentially a process to eliminate the chances of interest rate risk adversely affecting my portfolio. So bond immunization essentially occurs when we try to get the average duration of a portfolio to equal the investment time horizon for whatever our bond strategy is. So if you want to invest for 10 years, you need to create a bond portfolio that's going to have a duration equal to 10 years. If you do that, then the value, the ultimate investment goal that you have will be achieved regardless of what happens to interest rates between now and that 10-year window. Now what happens is time changes. So every year I'm going to have to rebalance that bond portfolio so it matches the ongoing or the remaining investment time horizon. So in 1 year, I'll have to rebalance my portfolio that had a duration of 10. I'll have to rebalance that so it has a duration equal to 9. And again, how this works in real life is fairly complicated. Most individuals are not going to be all that concerned about immunization. But corporations that have investment objectives for a bond portfolio, pension funds, insurance companies, all of those entities are very concerned about what interest rates are going to do to the values of their bond portfolios and their ultimate goal of investing. So it's much more of a corporate financial institution issue than a personal issue, but it is nice to understand how prices ultimately change and how sensitive they might be. So that's the end of the bond and bond price chapter. See you in the next video.